Well, taking a look at the local unit, we're sitting below the 660 mark at this stage of the game. Are you surprised at all by the kind of strength that's filtered through to the local unit?
Good morning, Alishia. Well, actually, we've seen the rand, of course, firstly taking advantage of ongoing broad-based dollar weakness, but also we've seen a bit of a risk-on trading theme coming through quite strongly. We've seen precious metal prices quite high, and we've seen equity markets in the developed world, at least, rallying quite nicely. And that's all on the back of an environment where monetary accommodation remains the order of the day, not least which from the Fed. So we've seen the rand strengthening not only against the dollar but against a broad range of currencies, and we now, in our opinion, in some pretty pivotal levels, because 658 was the level we reached back in December. That was kind of a 3-month high for the rand, and if we break through that 658 level, we could go all the way down to kind of 643. But of course, the corollary to that is if we fail to breach 658 yet again, it could be a very important technical signal that the rand is finding it difficult to breach that 658, and we could be then on track for some sustained rand weakness.
Of course, while it isn't the sole factor, as you highlighted earlier, we've got a dollar weakness very much in play and euro strength in focus as well. What are you making of the sustainability of the kind of euro strength we've seen filtered through, given the fact that the eurozone's problems haven't entirely dissipated, while for now we've got markets so concentrated on the comments out of the FOMC meeting yesterday?
I think that's right, Alishia. I think that we haven't seen the problems in Europe disappearing, and both the US and the European region has got some severe problems, which they both are yet to fully tackle. I think it's really a question of the lesser of two evils. We have a situation where the dollar now has been downgraded, or its rating outlook has been downgraded, and we've got still a very accommodative Fed. So I think at the moment the market is just seeing the dollar as the worst of the two evils, but it's not to say that Europe is any kind of shining light. I think it's just the Fed's accommodative stance versus a more hawkish ECB is the differentiating factor, and really it's just a choice of two evils.
Also to bear in mind is that we've got holiday trade, which is very low volumes playing itself out right now, and many saying that this is likely to worsen tomorrow, where we've got the UK all focused on the wedding, the royal wedding that's taking place. And at this stage it's hard to decipher whether price is actually reflective of mainstream thought or not.
Well, 100%. We've been crowded with a lot of holidays over the past week, and that's only going to really work its way out sort of towards the middle of next week. We've got a public holiday again on Monday. So I think we've got to really assess the situation once those public holidays are out of the way to see whether or not the investors, the main street, is really behind this move. But I think I wouldn't be surprised if the dollar remains weaker for longer. We've had comments out of the Fed last night that they're not chasing a weak dollar environment, but I think the writing's really on the wall. The Fed and the US economy needs a weaker dollar, and this whole currency war story that sort of came to the fore towards the end of last year, we've seen that the US authorities are actually winning this war, and that the dollar is likely to remain weak, and that will help their recovery ultimately.
Of course, we are awaiting those first quarter GDP estimates out of the US later on this afternoon. On home ground, we've got the SARB's leading indicator coming through as well, and that's set to give us some kind of growth outlook for the year ahead. Michael, what are you anticipating on that front?
Yes, we're hoping to see that there's more recovery on the GDP front. Of course, with commodity prices up here, we'd like to see sectors like the mining sector picking up. We'd like to see consumer spending also picking up. Consumers have been deleveraging for some time. but their wealth situation is now starting to show signs of improvement. Interest rates have been low, so possibly we could see the retail sector and any of the interest rate sectors also picking up. So we're hoping to see a bit more of an improvement on the leading indicator front. And then, of course, we've also got producer inflation, which is also something to look out for on the local front. And there we're expecting inflationary pressures to pick up from around 6.7% year on year in February up to around 7.2% for the month of March. So inflationary pressures are starting to pick up alongside an improvement in growth, which suggests indeed that the next move in interest rates in South Africa is likely to be up. We just don't think that the SARB is going to hike rates as soon as what the market is pricing in. We're still holding out for an unchanged decision in rates for the remainder of this year.